Now that you've done your risk profiling and you understand yourself better as an investor, the next thing you must look at is asset allocation. What exactly is asset allocation? Asset allocation is an answer to a number of questions that you have as an investor. The markets have gone up. Should I book my profits? The answer is look at your asset allocation. The markets have fallen down. What should I do with my investments in equities? The answer is look at your asset allocation. I invested money in a security and it has doubled from my cost. What should I do with my investment? Again, the answer is look at your asset allocation. Asset allocation basically is a determination of how much of your money should be invested in each of the asset classes that we've been talking about in our module 1 and 2. In the previous session, we looked at the returns from the 5 asset classes, and in this session, we will try and determine how much of your money should be invested in each of these asset classes. For the sake of simplicity and to get you initiated into what asset allocation is, we had clubbed debt and gold together as an asset class where you expect medium risk to medium return, and real estate and equity were clubbed together as an asset class wherein the wealth creation happens, and these are the high risk, high return asset classes. This is purely to introduce you into the world of asset allocation. It is not uncommon to look at asset allocation where you have a separate allocation for debt, equity and gold, and as you grow your portfolio, you will actually land up having individual allocations for all the 4 asset classes, that is debt, gold, real estate and equity. But for the sake of discussion and to get you to understand how asset allocation works, let's look at just 2 asset classes, that is debt and equity, and take this discussion forward. By now you agree that the real wealth creation happens only when you put your money in either equity as an asset class or real estate as an asset class based on the multiple returns that you get compared to the other asset classes. So a question to be asked is, when the returns are so high, why not invest all your money in equity? Well, this question has multiple answers. One, equity is volatile. We've already seen the historical chart of equity where it is not uncommon to see your money getting wiped out by 30 to 40% in a year, and even seeing your money double in a particular year. Equities as an investment is extremely volatile, and not every investor can stomach the risk or the volatility in returns that is associated with equity as an asset class. Since equity as an asset class is volatile, it does not guarantee that funds will be available at the point in time you need them. To give you an example, if you set aside 50 lakh of rupees to fund your kids' education in the year 2021, you want to send them for doing a master's abroad, and markets crash a year before your son is due to go for his master's, and your 50 lakh of corpus is down to 30 or 35 lakhs, what do you tell your son? Do you have an option to tell him that, son, since the markets have crashed, why don't you delay your master's by a year or 2? Or why don't you wait till we recoup our entire losses that we've made in the equity market? It is not a practical option, right? That is why getting all into equities is not a very good idea. The third reason why you would not want to be all in with respect to your equity investment is, whenever there is a correction in the equity markets and you want to take advantage of the correction, what do? You invest more into equities, right? But if you are already invested 100% into equities, how do you take advantage of the fall in the equity market? To take advantage of the fall in equities, you should have had some part of your money invested in debt so that you can pull the money out of debt and put it into equities when equities fall. Debt works as a cushion at the times when equities are volatile. It is your safety net when you see equities falling because of the volatility that you expect when you invest in equities. So the question to be asked is, when debt is a safe investment, then why not go all into debt investment? The answer to that is very simple. The returns that you earn from investing in debt products are too low to create real wealth for you. If you look at the returns that you earn from your debt investments, they very closely track the inflation that you face. Inflation is basically the rise in the prices of your goods. When the returns from your investments are very close to the inflation that is prevailing, you are actually not creating wealth, because when you deposit 100 rupees and a year later it becomes 106 or 107, and if you want to use it to purchase a product which was worth 100 today, but a year later it is worth 106 because of the inflation that is prevailing, there is not any real wealth creation happening because you are just being able to afford the product a year later. The role of RBI as a regulator for banks is to keep a tab on inflation, and they do that to an extent by keeping a tab on the interest rates. If the inflation is too high, they would increase the interest rates to reduce the demand of products and in turn reduce inflation, and vice versa. If you look at the deposit rates, if you were to put your money in a developed country like US, you find that the inflation rate in that country is less than 1%, and the fixed deposit rate currently prevailing there is also about between 1 and 1.5%. So you can see that your deposit rates that you earn will always closely track the inflation that is prevalent. Either you will make money which is equal to the amount of inflation or slightly more than inflation. And in rate scenarios like today, where a FD rate is giving you 5.5%, whereas the inflation is 6%, you actually are not making any money. You're losing money on your fixed deposit investments. Because of the fact that the returns from fixed deposits or debt investments will always closely track the inflation prevailing, you actually do not create any wealth in the long term. So it's not a good idea to go either all into equities or all into debt. What you need is a good mix of all the asset classes. We've already discussed that cash as an asset class is held for emergencies or when you're looking for better opportunities. Whereas debt as an asset class forms a safety net, and it is the place where you hold all the monies that you require for the short term, that is up to the next 3 years. Gold helps you manage the volatility in equities. We've already seen before that gold and equity have kind of a negative correlation in terms of the returns that they've given in the past. If you look at this chart, in the year 2008 when equities crashed world over, it was gold that gave a pretty good return. The same thing happened when the markets corrected in 2011, and even in 2020, the fantastic returns that gold has given is partly to do with the fact that markets crashed in the month of March, resulting in gold being attractive as a safe haven. Because of the negative correlation between gold and equity, gold helps you offset part of the volatility associated with investing in equities. Real estate, we've seen, is a fantastic asset class when you want to build a monthly income portfolio, apart from helping you create wealth through price appreciation. And finally, equity. The only reason you own equity as an asset class is for wealth creation. If we take the example of Mr. Aditya Puri, the ex-MD of HDFC Bank, he sold 95% of his stake in HDFC Bank when he left the bank. That actually created a small flutter in the market wherein people asked him questions that, don't you believe in HDFC Bank as an investment? Why did you sell most of your stake in HDFC Bank? He had a very straightforward answer which goes back to what we are learning now about asset allocation. He said, my selling or buying shares has got nothing to do with what HDFC Bank does. If you were a 70-year-old man, would you have kept all your eggs in one basket, and that basket is equity? So the actions of Mr. Aditya Puri are basically a follow-through of following the principles of asset allocation, where you must not have all your investments in a single asset class, whether be it equity or be it debt. And even within the asset class of equity or debt, you should not be having all your investments in a single security, right? Even within his allocation of equity, if he were to put all his money in HDFC Bank alone, it may not be a good idea because then he has too much exposure to a single share. An investor's goal is to maximize the returns for a level of risk which you are ready to bear as an investor. Or to put it other way, your goal as an investor is to minimize the risk for a certain return that you want to target and achieve. And your risk can be reduced by holding a diversified portfolio of unrelated assets. Basically, this means that you should not be investing all your money in a single security or even in a single asset class. You should not put all your eggs in a single basket. While all of this looks good in theory, let's look at the practical returns different assets have given us over the past 10 years. If you look at the returns of different asset classes over the last 10 years, what you can see is that there is not a single asset class which has consistently been in the top returns in any year. Every year you've had a different asset class which tops in terms of the returns that it has generated. If you were to look at the returns of the past 5 years, in 2015, credit risk mutual funds, which is a category of debt mutual funds, were the best performing asset. Whereas in 2016, surprisingly, government securities, which is an asset class which has almost zero risk associated with it in terms of default risk, obviously they bear the highest interest rate risk. It is the asset class which gave you the highest returns. Whereas in 2017, it was small cap mutual funds which gave you the highest returns. In 2018, it was gold, and in 2019, it was international equities that gave the highest returns. So even within equities, it was not domestic equities, it was equities into international stocks that gave the highest returns. With every asset class performing differently in each year with no consistency in terms of a particular asset class constantly being the top performer or even within the top performers in a particular year, then the question is how much of your money you should get into which asset class? And to help you answer that question is where we introduce asset allocation. The reason why asset allocation is important is 90% of your returns as an investor are determined by the asset class you're invested in and not by the actual security that you hold. What I mean by this is the decision of how much of your money gets into debt versus equity determines 90% of the returns that you earn as an investor, whereas the balance 10% is determined by whether you're going to buy a HDFC bank or an ICICI bank. Given that asset allocation is so important, then how do you determine what your asset allocation should be? Now let's look at two ways in which you can determine your asset allocation. The first one is asset allocation determined by your age. This is a very simplistic way to understand how much of your money should get into debt and how much should be invested in equities. So if your age is 25, you should put 25% of your money in debt and 100 minus your age will get invested in equities. The logic behind this is the younger you are, the higher is your ability to take risk, right? If you go back to our previous session, we had discussed about ability and willingness to take risk. So the younger you are, you have a higher ability to take risk because when you put a higher amount in equity, if for some reason there is a fall in the equity market, since you are earning from your regular salary income or your professional income, it will not affect you and you have a long period of time in which you can recoup those losses. And given that equity is an asset class performs well with lower risk when you are invested in it for a long period of time, so the younger you are, the higher is the risk you can take by allocating a higher amount of money into equities. As you age, you would want to reduce your allocation to equities and increase your allocation to debt. So by the time you reach the age of 55, your allocation to debt should be about 55%, whereas your equity would fall to 45%. This debt equity allocation is a very simplistic way for you to get started, and it kind of acts as a pointer for you as an investor to do a check on how much of your money is invested in debt and how much of it is in equity. A more scientific way to determine what your debt equity allocation should be is what we've done in session 1, wherein you sit down and do your risk profiling. Once you do your risk profiling, it gives you an answer of what kind of investor you are. You may be an aggressive, a growth investor, a balanced investor, or a conservative, and finally a defensive investor. Each of these categories of investors have a certain debt equity assigned to them. So an aggressive investor can go 90% into equities, whereas a defensive investor will have major chunk of his money invested in debt investments. Once you do your risk profiling and determine your profile as an investor in terms of what kind of investor you are, what is your ability to take risk and what is your willingness to take risk as an investor, the next step is to allocate your money based on the asset allocation suggested for your risk profile. And once you get into your investments based on your risk profile, that will automatically determine how much returns you must expect as an investor based on your investment profile. So obviously an aggressive investor, will have a much higher expected rate of return of 14.3%, whereas a defensive investor will have a much lower rate of return of about 8.7%, assuming you earn 8% in your debt investments and 15% in your equity investments. I would request you to pause the video here and go on to the next section, wherein you have the asset allocation tool which has been provided to you to help you determine what exactly should be your asset allocation. So the question is, how does asset allocation actually help us? Asset allocation helps us in two ways. One, it helps us decide when to buy and when to sell. And second, it helps us keep our emotions in check. Let's look at the first factor. As an investor, it is difficult or rather impossible to know when markets have reached their all-time highs and it is a good time to sell, or when markets have corrected and reached their all-time lows and that is the best time for you to invest or enter the market. There is not a single investor till date who has been able to time the market well. Time the market well meaning enter the market at its absolute low and exit the market at its absolute high. There is no investor who has been able to do it consistently. There is no algorithm which has been able to do it consistently, because of which if me and you try and do it, it's only going to result in losses and a bad experience at the end of the day. If I give you the example of one of the greatest investors we've ever had, Mr. Warren Buffett, when the markets crashed in March 2020 because of COVID, and which actually raised a major question mark on the kind of returns you can expect if you are invested in the airlines industry, an industry that is affected the most because of the cancellations and the restrictions put in because of COVID. Mr. Buffett actually went ahead and sold his entire portfolio of investments in airline stocks from United Airlines to Delta to Southwest. If you look at the rates at which he sold these shares, if you take an example of Delta Airlines, he sold the shares at $20 a share and the share price actually eventually went up to $31, $32. So a simple question is, when Mr. Warren Buffett could not time the market in terms of when he should exit his investments, what about investors like me and you? And that is why we need an aid to a tool called asset allocation to help us make this decision. So how does asset allocation help you decide when you should buy and when you should sell? Let us take an example. If you held a portfolio of INR 10,000 which was invested 70% in equity and 30% in debt, you would have an allocation of rupees 3,000 towards debt and INR 7,000 towards equities. With this holding, if there was a market crash and the value of your equities fell by 35%, which is very similar to the market crash we saw in March 2020. So if your equity holdings fell by 35% and fell from INR 7,000 to INR 4,500, the question you need to ask yourself as an investor is, what should I do next? To help you find an answer to this question, you must go back and look at your asset allocation. What was your original asset allocation? Your original asset allocation was 30% debt and 70% equity. But as a result of fall in the markets, what has happened is you are left with the same INR 3,000 in debt, because debt is not affected by fall in equity markets, whereas your equity holdings have fallen to 4,500. Your new debt equity allocation has changed from 30-70 to 40-60. You now hold 40% in debt and 60% in equity. But what was our suggested asset allocation which you arrived at as a result of your risk profiling? It was 30% debt and 70% equity. Because of this market crash, since your asset allocation has gone out of sync, it is at 40-60, whereas the suggested allocation for you was 30-70. What you need to do is you need to sell some of your debt and buy some more equity. So asset allocation helps you decide that you should go ahead and sell part of your debt and buy more of your equities. The next question you ask yourself as an investor is, how much of debt should I sell and how much of equity should I buy? The answer to how much also is given by asset allocation. You sell enough of debt and buy that much of equity so that your asset allocation today, which is 40-60, is brought back in sync to your target asset allocation of 30-70. If you were to look at this in terms of numbers, what you need to do is, today you hold a portfolio of INR 7,500, which is a portfolio which has reduced from 10,000 to 7,500 because of a market crash. What you need to do is, you need to hold 30% of it as debt and 70% as equity. So 30% of 7,500, your target debt allocation should be 2250, whereas 70% of 7,500, which is 5250, should be your target equity allocation. So what you'll do is, you will sell your debt, and how much will you sell? You will sell to equal to an amount of 750, and you will go and put that money into equities, and that will increase your allocation in equities from 4,500 to 5250 and result in your portfolio being in sync with your target asset allocation of 30% debt and 70% equities. By sticking to this principle of asset allocation, what you're forced to do is what you should be doing if you were to just apply common sense. Common sense says that you should buy equities when they are cheap and sell equities when they're expensive. If you were to relate this to, when do you actually go shopping for clothes or shoes that you need to buy? You wait for the sale season, right? The best time to buy clothes and shoes is when they are cheap, when they are available at a sale. That's exactly what is applicable when you go and buy equities. You should buy them when they are cheap. So when equities have fallen for whatever reason, be it because of the market reasons, say in this example, it was because of COVID. Earlier, it would have been because of the fight between US and China. Another reason before that would have been because of the market crash in 2008, because Lehman Brothers went bankrupt. Whatever be the reason because of which markets are corrected, that gives you an opportunity to buy markets or buy equities at a low price. That gives you an opportunity to buy equities when they are cheap, so that you can result in higher returns over a longer period of time. Mr. Benjamin Graham, who is also considered by Mr. Warren Buffett as his guru, has very rightly said that investors should purchase stocks like they purchase groceries, not like they purchase perfumes. So generally when you go and buy a luxury product, you're looking at the brand, you're looking at the experience and the feel. You are not bothered too much about the price associated with these luxury goods. Whereas when you're buying groceries, you're extremely stingy about even the 5% or a 3% discount that you get when you buy those groceries on a monthly basis. So what advice Mr. Benjamin Graham says is that you should buy equities just like you buy groceries. You must be extremely stingy when you're buying them. You should be extremely conscious about the price that you're paying for buying them, and that is the one factor which will help you make good returns over a long period of time. And investing in equities by following your asset allocation kind of forces you to buy equities when they are cheap or when they have fallen, and helps you take advantage of this principle. While it is very easy to talk about buying equities when they are cheap, when you want to go and implement it in real life, it can be extremely difficult. Why don't you rewind back to March 2020, when the markets were crashing because of the COVID news, and suddenly there was a lot of uncertainty in terms of what is going to happen next. Were you actually sitting with a portfolio of yours and thinking, it is a good time for me to buy equities, I should go and put more money into equities? The reason it is difficult for you to do that is because of the plethora of newspapers and news articles around you, and the analysts screaming at the top of their voice that the markets are crashing, it's a scary time to be in equity markets, your returns are going to be bad and you lose your money, the recovery is not in sight, etc., etc. It is a very difficult time to be invested in equities when everything around you is negative about equities. So the second reason asset allocation is important is it helps you keep your emotions aside and invest in the equity market without being bothered by all the outlook, which can be extremely negative at a time when equities have fallen and they are very cheap. That is why it is said that an investor's worst enemy is not the stock market, but his own emotions, which result in irrational responses to the volatility of the stock market. Asset allocation helps you to keep these emotions under check, cut away all the noise around you, and make a rational decision with respect to your investments. Now that you understand the benefits of asset allocation, let's take a pause here and do a reality check of where does your portfolio stand in relation to your standard asset allocation as you determined under the risk profiling section of session 1 of this module. Refer to the asset allocation tool which you will find in the section immediately after this section and download the tool, and let's start filling it up together. When you open this tool, you will see that on the right hand side top, it will ask you to fill your risk profile, which is the profile which was determined when you ran through the exercise of risk profiling in session 1. Put in your risk profile here. Once you've put that, come down and make a list of all the debt investments that you have on the left hand side and all the equity investments that you have on the right hand side. Once you put in the current values of both these investments, you will get what your allocation of debt to equity is versus what it should be based on your risk profiling. And the tool will also suggest whether you must buy more of debt or buy more of equity. So this tool gives you a reality check of where your investments actually stand as of today compared to where they should be based on your own analysis of yourself as an investor. A very common question that gets asked is, once I know my asset allocation and I have invested my funds as per my asset allocation, then what is the trigger point for me to go and do a rebalancing of my portfolio? Obviously, you do not want to be rebalancing your portfolio for every small movement in the stock market because you have two costs associated each time you have to buy or sell any particular security. One is your transaction cost and second is your taxation cost. There are two trigger points you must look at before you decide on when you should rebalance your portfolio. The first trigger point is if your asset allocation is out of sync by more than 10%. If your risk profile was that of a growth investor and your allocation was 30% debt and 70% equity, if this goes out of sync by more than 10% because of movements in the stock markets, that is when you must go back and look at rebalancing your portfolio and bringing it back in sync with your stated allocation of 30s to 70. The second trigger point can be when the markets move by more than 20%, whether the move is an up move or a down move. If the markets have moved more than 20%, that's the second trigger point for you to go and have a look at your portfolio and decide whether it requires to be rebalanced or not. Again, these two triggers of 10% for trigger 1 and 20% for the movement in the markets as per trigger 2, they are not sacrosanct and standard numbers, and the trigger you would want to set for yourself is a function of what you are as an investor and what is the kind of risk that you're ready to take, which will determine what trigger you set for yourself. But the triggers we've given you of 10 and 20% are good numbers to start with, and as you rebalance your portfolio with changes in the markets, you may want to change these trigger numbers based on what you feel comfortable with. Now that you know the benefits of asset allocation, have seen how it works, and you also understand when is a good time for you to go and relook at your asset allocation in terms of changes in the market conditions, the next question is, can you do better than this? Or is there something which will help you do better than what asset allocation does for your portfolio? Here is where we introduce strategic asset allocation. Now, what exactly is strategic asset allocation? Strategic asset allocation is a purposeful deviation from your standard assigned asset allocation because you would want to take advantage of any extreme movements in the markets. Let me explain this with the help of an example. If your standard asset allocation is that of a growth investor and you have 30-70 as the allocation between debt and equity, if for some reason markets fall and they've fallen by more than 30% or even higher, and you find that it is an extremely interesting time to buy equities because they are available cheap because of the external market conditions, then when you do a rebalancing of your portfolio, instead of rebalancing back to your standard asset allocation of 30-70, you can rebalance it to your strategic asset allocation, which is 20-80. Here, the strategic asset allocation is deviating from your standard asset allocation by a maximum of 10 percentage points, which allows you to go overboard on equities by more than 10% of your standard allocation, because you think that the market conditions are extreme and this is a condition which you want to take advantage of, and you think that equities are cheap and you should get into equities now, and you can go overboard, but only to the extent of additional 10%, resulting in your strategic asset allocation being 20:80 versus 30:70. This applies for whether the markets go up or they come down. If you result in a scenario where markets have gone up and you find equities are very expensive and you're not comfortable with that level of equities, you may want to sell your equities and bring it back to your standard asset allocation of 30:70 in a normal scenario. But in this scenario where you think the markets are extremely expensive, you come down to a ratio of 40:60, that is 40% debt and 60% equity. So here you're selling equities more than what you would sell in a normal scenario to the extent of 10% and bringing down your asset allocation to 40% debt and 60% equity. Again, here your strategic asset allocation, which is a purposeful deviation from your standard asset allocation, it can be 5%, it can be 10%, it can even move up to 15% if it suits you as an investor, it matches with your risk profile. A high risk, high return investor can live with a higher deviation, whereas a low risk, low return investor would not want to deviate from his original risk profile. So you've seen how asset allocation helps you determine how much of your money should get into which asset class, which allows you to take the benefit of what each asset class has to offer you. How much you put in each asset class is a function of your risk profile, which will help you determine how much of your allocation goes towards the riskier asset classes and how much of it goes towards the less riskier asset classes. And by sticking to your asset allocation, irrespective of what the market conditions are, you will be able to respond to the market conditions by cutting out your emotional biases and respond in a very practical and in a strategic manner, which is through a time-tested method of using asset allocation so that you can make the most of it. While you've seen what asset allocation can do for your portfolio, do you think it actually works? In the next section, we will do a run-through of asset allocation in sync with the actual market conditions and check whether asset allocation actually works for you or not.